Okay, good morning to everybody. Today is the 18th of November. Today is Tuesday, 11/18, and I'm going to talk today about some more content regarding Chapter 11. And remember, Chapter 11 sort of rounds out the last of what we're covering in terms of the so-called left side of the balance sheet. Again, the balance sheet, we say left or right. It's more of a metaphor than anything. In the old days, you used to have balance sheets on the assets on the left side and liabilities and shareholders' equity on the right side. And so the metaphor still applies, but we're going to sort of finish up this issue in terms of long-term assets. And when I say finish up, I don't think I'm going to actually get through everything I want to get to today. And I'll probably post a supplementary video tomorrow or Thursday, something like that, in order to sort of round out the discussion. This is a dense chapter. I think I mentioned that at the outset. There's a lot going on here, and but I don't think it's the most complicated piece of the course. I really don't. A lot of it deals with depreciation, which is relatively straightforward. And again, as you approach things like quizzes, homework, and exams, you're able to use your text to sort of refer to, hey, what was in the numerator, what was in the denominator, and all that. So I think those are good reference points for you to look at. So for this week. Obviously, we're in week 12, and we're a little bit behind, but we're not super behind. And again, the syllabus seems to sort of have been written more during COVID when we would have, like most everyone was pretty much online. We're going to carry chapter 13 forward here, and we're going to get to that beginning on Thursday. So I'm going to do what I can today in order to sort of cover most of the rest of what we're talking about with Chapter 11 and dealing with things like how we treat dispositions and all that. The due date for the quiz and the discussion post is going to be Friday. So remember to post to the discussion. This is really low stakes activity. There's not much in the way of requirements. Just sort of follow the prompts and answer what's being given. You don't have to go crazy. Sometimes people put pages and pages. This is not a paper. I wouldn't even describe it as a paper, but really a response to a prompt, and then just kind of engage with your fellow class participants. Student-student interaction is oftentimes a pretty valuable teaching tool. And so keep in mind, if you haven't posted yet, which is fine, it's only the 18th, you've still got some time to do it. So just make sure you can post that discussion by Friday, and then post to some other class members as well. So not over the weekend, but give us a good 3 sentences, at least, beyond just the salutations and the congratulations. For whatever reason, students like to congratulate each other on the quality of their peers' discussions, which I've never been able to figure out. But nonetheless, just kind of keep it content focused. So that's what's due for Friday. By the end of the week, then you want to sort of focus on what's going on with regard to Chapter 11 homework in Connect. Okay, so I'm going to start on Thursday talking about Chapter 13, which, as I mentioned in my announcement yesterday, we're going to sort of cross over to the other side of the balance sheet to talk about the equity side. And remember, when we talk about the balance sheet itself, which is probably the most important statement of all the major financial statements, the balance sheet, I think most accountants, and I'm one of them, would say that the balance sheet is the most important because it kind of gives an idea of where things are. It's a snapshot. It's a freeze in time, and it tells where things are. And so we're going to sort of go over to Chapter 13 on Thursday and focus on that. By the way, we're going to lose a day next week because of Thanksgiving holiday, which obviously we all want to have. But I'll try to bring everything current as of that time period. Notice the due dates here with Chapter 13. Part of the problem is that I know that the Smart Book quiz is due 11/28, it's the day after Thanksgiving. If you want to do it early, feel free to do it earlier. In fact, feel free to do anything earlier as you approach this. I want to talk more on Thursday about the ethics case and go through what's going on there. I think that we can overthink this a lot, and most people do very well on it because it's really sort of an issue where it's not so much calculations and whatnot. It's more of a logic problem, and where you're sort of being asked to address a particular situation. And one of the things about ethics is that we're sort of being mandated by our accrediting bodies to talk more about business ethics in pretty much every business school, and particularly in accounting, because the accounting profession sort of got itself a black eye in the early 2000s with the Enron case and the MCI or the MCI. What was it? It was Enron, WorldCom, Global Crossing, and all that. So a lot of changes were made. We've talked a bit about Sarbanes-Oxley, and which was passed in 2002, in order to sort of address some of these irregularities. A lot of it has to do with auditing, which does not really deal with what we're doing here. Almost nothing of it has to do with tax, which is primarily my area. But nonetheless, there are issues where accountants need to act in an ethical manner, and it comes up again and again and again. In fact, I don't necessarily consider myself as much an accountant as I do a business professor. And one of the things that we should talk about is the idea of business ethics, because even though it sounds like a contradiction in terms, people sort of sometimes snicker at that. It really is an important aspect of what we're doing. And if we don't follow the rules, then the rules don't mean anything. So that's what's going on. I'll talk more about that on Thursday. We'll get to that, and we'll cover more of what's happening there. Okay. All right, so let's pick up on chapter 11 from where we left off last time. I think we were sort of around here, at least from where I flagged my notes. Oh, and by the way, I mentioned this in my introductory note in Brightspace yesterday, but I'll be posting supplementary videos as we go, and you'll find them under the learning modules for the chapters to which they correspond. I know that the Brightspace course is laid out with week, chapter, whatnot. But I like to sort of push due dates back as much as I can, just to give you more time to do things. And so focus more on the chapter than the week. And because really we're in week 12 right now. Actually, we're in week 11. I think we're in week 11. Let me see here. But focus more on the chapter. I know we're in week 11. I'm sorry, we're in chapter 11. Yeah, but we're actually in week 12, which began 11/17. So focus more on that. And I'll be posting these supplementary videos just to kind of give you a bit more update as to what's going on. And if you like them, that's great. If you don't like them, they don't benefit you, well, that's completely up to you. There are plenty of students who've studied accounting, gone all the way through to the CPA exam, and really have never attended a class at all. They've done them, sort of remotely. If that works for you, that's fine. We all learn differently, but I am here. I really am here every day, and I'm here to help you. So, okay. All right, so let's pick up from where we left off. We were talking about changes in methods, and we're going to talk more about this. It's going to become a little bit more, I guess, of a severe remedy when it comes to dealing with changes in methods. But we talked a bit about this example of the company that was changing depreciation methods, or I'm sorry, changing depreciation amounts in terms of estimated useful life and residual value and whatnot. So we're going to talk here about methods, which is different, okay? And this is a different kind of thing. So prior to this, we talked about an example when a company said, okay, we have an asset, I forget the years, I think it went 5 years to 8 years, where we said we have estimated useful life. Going into the asset, we said it's going to be a useful life of 5 years at $20,000 of residual. Now we think it's going to last 8 years. That's going to be the estimated useful life, and the residual is going to come down. And so, but that's an issue where we are changing estimates, and this is not unusual at all. Companies a lot of times assess their fixed assets and say, well, this asset is going to last longer than what we thought it was going to be, so we're going to take a smaller depreciation over time. And by the way, why would a company want to do that? Well, if they're reporting financials to external users, taking smaller depreciation means a smaller expense on the income statement, which has the effect of raising net income, obviously. And so that might make sense. On the other hand, sometimes they may say, and they're required under the GAAP standards to say, this asset is not going to perform over the next X number of years that we think it was going to perform. So we're going to change that particular estimate. Those are changes in estimates. And let's be clear, changes in estimates do not require we go back in time and restate financial statements. All we're simply saying is, as new information is developed, we, the accountants of XYZ Corp, determined that there are some material changes that we need to make. And so all we're simply saying is there's a change in estimate. Here we're talking about change in method. So the change in estimates is oftentimes done by an accounting principle, and whatever that principle might be. And it's done the same way as any other change in the accounting estimate. And again, as we've said many times before, a change in the in the estimate or the method requires a note to the financial statement. So let's talk about the change in method here, okay? All right, so we saw earlier, and let me just kind of go back here a little bit. I want to go back. This is a change in accounting estimate. This is the example, the Hogan Manufacturing Company, where on January 1st, 2019, the company purchased a machine for $250,000. At the time of purchase, well, all this information is given, and it's also in the text. Service life is 5 years, residual value 40,000, and I think they're using straight line, so you take cost minus salvage, which is 210 divided by 5, gives you 42,000 a year. And at 2 years, they decide, okay, we're going to change the method, okay? Or we're going to change the estimate. And this is the previous example. This is not what I'm talking about here. This is the previous example where we're saying, okay, the useful life has changed. And because the useful life has changed, we got to bring down the salvage value, because if it's going to have 2 more years, was it 2 or 3? Of estimated useful life, then obviously the it's 5, 2, well, it is 2 years, right? So it's 2 years. So it's the salvage value is going to go down because it's going to be worth less in 2 more years subsequent to that. So that makes sense, right? But this is a change in estimate. There's nothing there's nothing that was wrong. We're assuming there's no good faith effort to deceive users or whatnot. We're just simply saying, okay, we have ascertained that things are changing, okay? But let's go back to where we were before, because this is really the important part here, is the idea, now we're going to change methods. And in this case, and remember, intermediate accounting is very often centered around the idea of applying methods to accounting issues. And if I had to describe intermediate accounting, I'd say it's 2 things. It's number one, it's a walk around the statements, the financial statements, but it's also a sort of a deep dive into the methods that are used in order to handle accounting problems or issues that come along. So in this case, let's go back to the same facts here. January 1st, 2019, Hogan bought a piece of machinery for $250,000. The company expects the service life to be 5 years, and anticipated residual value is $30,000. Those facts are a little bit different here, but the company's fiscal year is December 31st, and the double declining balance method is being used, okay? Remember, here we do not take residual out of the numerator as we divide it in, by the estimated useful life. So that's one thing to think about here. But now we're switching to straight line. Now, why is the company doing this? I don't know. I'm not sure why. It doesn't really matter why they're doing it, as long as they have a pretty good rationale, right? And in the tax world, you can't really do that. It's not going to be, the IRS is not going to allow it. But in financial accounting, maybe it makes sense. Maybe there's a reason why you want to take the even depreciation, which is what straight line really refers to. It's called straight line because the slope of that declining balance is going to be constant. So in this case, what do we got? All right, so let's just kind of recreate history here. On January 1st, they bought an equipment for $250,000. Remember, it's like a 5-year life. So under straight line, remember what double declining balance is? It's twice the straight line depreciation rate. 5-year property would be depreciated 20% per year. We're going to amp it up to 40% per year. So 40% times this is 100,000. So that's going to be the first year's depreciation, which we're going to deduct from the book value, because remember, we don't start with cost minus salvage. We take the adjusted book value every year. 250 minus 100 is 150 times 40% is 60,000. So accumulated depreciation after the 2 years, right? Because we're saying in 2 years' time, we're changing the depreciation method. And so as a result, we've accumulated depreciation of 160. So 250 cost minus accumulated depreciation gives us a undepreciated cost, or net book value in this case. But now we're going to go to straight line. And what does straight line do? It estimates we take into account residual value. In this case, it's 30,000. So we subtract that, and that becomes the depreciable base. This is the numerator that we now use to go forward for the rest of the accounting period, right? So we're changing methods. Remember, the previous case that we talked about last week was the idea that we're changing terms, the length of time, the estimated useful life is going to be longer. And because of that, the estimated, the residual value is going to be lower. Well, no, we're not really changing that here. Although I think they changed from 30 to 40. That doesn't really make any difference. It's the idea that we're changing the method. So this is the depreciable base divided by the remaining 3 years. We're not changing the term of the estimated useful life. So it's going to be 20,000 is the new annual depreciation. Okay, which is quite a lot different than 100,000 and 60,000. Now we know that double declining balance is an accelerated depreciation method, and we know it's acceptable, and some companies will choose it. And there is some accounting logic, there's some accounting theoretical logic that says that, okay, some assets are more productive in the early years than the later years, and so therefore accelerated depreciation is necessary. We can debate this all day long, and this is accountants for years have gotten arguments with each other as to what method is to be used. But here we're changing a method for whatever reason. We're not really giving the background on this, but it doesn't really make any difference. What we're more interested in is what the effect is going to be on depreciation. And so as a result, we're going to have a $20,000 annual depreciation, which is going to look like this: depreciation expense, debit, 20,000. That's an income statement item. An expense, a debit, and accumulated depreciation. The contra asset to the asset in particular, the depreciation of the whatever that machine was, it's going to be 20,000. So as a result, it's a contra asset that balances out. So, and that's the journal entry for that particular period. Once we establish that we're changing methods, and companies do change methods, for all kinds of different reasons. It's not extremely common, but it does happen, and they do it. But when they do it, they have to explain why they're doing it. And because users really want to know why they're doing it. So as a result, we end up with a statement that's required. And the notes to statements, and I have said this a gazillion times before, the notes to financial statements tell a lot about what's going on. So, and this is to inform users as to what's happening. And this is an area that I think a lot of people miss. The layperson that simply invests in stocks and bonds and looks at company financials, and sort of skips over what they think is the fine print. Well, fine print really describes what's going on. And I realize it's something that accounting professionals are more attuned to than the average person. And I get it. But we're living in a world that's complex anyway. And my doctor explains to me why I've got asthma and all that. I don't really get it, but I take his point of view and so whatnot. And so this is why professional responsibility is important, because we understand that a lot of users don't get all these details. And so we've got to make sure that we're communicating accurately, completely, and thoroughly, and that we're in an ethical sort of manner. So in this case, here's a note to the financial statements. Agrium Incorporated changed the method of depreciation from straight line to, what was it? This was a long sentence here. From straight line to what? I don't think it actually says here, does it? Units of production, right? Sorry, I missed it. I didn't see it, so I was kind of looking forward here. So they're going from straight line to units of production, and that's a change in method. This is not a change in estimate. Remember, change in estimate is a case where we say, hey, this asset's going to last longer or shorter, whatever the case might be. The residual value is going to change. And by the way, and I've told the class before that I used to deal with a lot of trucking companies, and a lot of times they would say this truck is no longer going to be as necessary as before. The market value is going to really fall. Therefore, the residual value is going to be less. We're going to mark this thing down. And because trucks were changing, truckers were really sort of demanding a lot more amenities on their trucks themselves. And so as a result, they were sort of changing those. And the residual values were changing. Now, this is residual value change, not so much an EUL, estimated useful life change, but you get the idea. But those are changes in estimates. That's not a change in method. A change in method is where we're saying, hey, we're going to go from straight line to, in this case, units of production. So that's a change in the way that we estimate or account for the change, the allocation of the cost over time. Now remember, let's just kind of circle back to what we're talking about in the first place. We're talking about allocating the cost of a long-term asset over a period of time, and we're recording it as expense over time. And how do we do that? We do it by this particular issue. So it's a change in method. All it is changing role. Okay. All right. Quick question here. The quick quiz is: On January 1st, 2019, the Herald Company purchased equipment at a cost of $400,000. The equipment is expected to have a service life of 10 years and a $20,000 residual value. Okay. Again, these are established up front at the time of booking this asset, right? The company's fiscal year is 12/31. That makes it easy. And the double declining balance method is used. Okay. So at the beginning of 2021, the company switched from double declining to straight line. So what is the adjusting entry to depreciation expense? Well, the first thing, when we say adjusting entry, all we're really saying is that depreciation expense and the recording of it is an adjusting entry. And that is, how does that differ from other entries? Because some entries are simply due to transactions. We sell goods, we collect a receivable, we book it, we collect cash, we pay down on note, we do all these things, right? But depreciation, there's no event, there's no trigger. We have to do an adjusting entry. And so adjusting entries are what I like to refer to as sort of maintenance, routine maintenance, where you kind of got to go in and make the change. And this is by far not the only area in which adjusting entries are necessary. But nonetheless, they are, as we approach the end of an accounting period and statement preparation. So let's go back to the facts here. All right. So service life 10 years, so 400,000 minus 20,000 residual, and they're using double declining balance. Well, we don't care about the residual under DDB. We're taking 400,000 times what? 0.1, right? Which is 10%. And we're going to do it for 2 years. And so that's going to bring, so 40,000 is going to bring us down to 320, right? So let's just kind of look at the solution here and walk through this. And if you have questions about it individually, feel free to get with me. But all we're doing is simply walking through this accounting period. January the 1st, and I know January the 1st, and all of that, obviously firms tend not to buy assets on January the 1st, but you kind of get the idea. So we're taking 400,000 times 20%, which is double the 10% rate, because of a 10-year life, which would under straight line be 10% per year, but we're doubling it, hence the term double declining balance. So the first year, 400,000 times that is 80,000. We subtract the 80,000 from the book value of 320. So we use an adjusted basis, right? 400,000 minus 80,000 is 320 times 0.2 is 64,000. So that gives us accumulated depreciation at the end of 2 years of $144,000, right? Okay, which 144 away from 400,000 is going to be 256. And now we're saying we want to go to straight line, and we will take the 256 minus the residual of 20,000 here, okay, to give us a new depreciable basis. That's the numerator in the equation as we go forward. We're not changing estimate. We're not saying the residual is going to change. We're not saying the estimated useful life is going to change. We're saying we're going to change the method. So it's 236 divided by the rest of the time, which is 8 years, and it's going to be 29.5 every year as we go forward, simply because the fact that we're changing methods. And why would the company do it? I don't know why the company would do it, but they do it, right? And it may make sense to go in this direction, right? It could be, and I guess you were sort of cynical. You would say, well, we're going to take the early depreciation up front, get it out of the way, and then we're going to sort of straight line the rest of it over time to take a lower amount. Who knows? I mean, there are all kinds of reasons why companies would change methods. But if you do change a method, then we have to account for it this way. And again, we need to explain to users why it's being done, what's going on, why we did it, what the reason is, and what the results are going to be. And in fact, what the results are going to be in terms of the change in net income and also earnings per share and all that. So, okay. All right. So I think this leads us then to talking about this idea of errors. This is different than estimate changes or method changes. All right. So in chapter 11, we have talked about the idea of changing estimates, where all we're doing is simply saying, okay, at the beginning of this asset acquisition, we thought it's going to be useful life of 5 years, and it's going to be residual value of 20,000. But now all that's changed, and we're going to change that. Okay, so the estimated useful life is 8 years, and the residual value is 10,000. So that's a change in estimate. Or change in method says, this idea we're going to go from double declining to straight line, or a straight line to units of production, or any combination of all these things you want to go within any company, and the company needs to explain why they're doing what they're doing. And one thing we said about this is the idea that we don't change financial statements going backwards. We don't recreate history and say, you know what, we should have been straight lining this the whole time, but we didn't, and we're 3 years in, and let's just go back and redo the last 3 year statements. We don't really do that when it comes to changes in estimates or changes in methods. Either one, it's not what's done. We simply say, okay, from this point forward, we're going to sort of change the accounting method as we go. But that's different than errors. And I talked a bit about this last week in the sense that in the two prior cases, changes in estimates and changes in methods, we don't go back and recreate history and restate financial statements. We just don't do it because, first of all, it doesn't make any sense to do it because theoretically, the management didn't decide that there was a change until a certain point in time, and that as we go forward, we're going to sort of change our estimates, as long as we disclose it and explain to users what's going on. Here, this is a different story. This is where there's an error, and there's something that's gone wrong. We've missed something, and it happens, and it just does, where something's not recorded correctly. A lot of times we see this with affiliate operations where we're not fully consolidating operations from subsidiaries or affiliates, and companies are so spread out today, operations all over the world, that there are errors that happen, right? And because of that, sometimes we need to go back and restate financial statements. Now, one thing I said, I think it was on the video I recorded as a supplement to this particular chapter, was the idea that sometimes companies will have to restate financial statements. When they do, it's a pretty big deal. The financial community doesn't like it very much, and they say, "Do you know what you're doing?" And that's usually much more harsher terms than that. So, but when there's an error that's going on, it has to be corrected, which means you have to go back and you have to restate financial statements for the periods that are affected. It's usually balance sheet, income statement, but also retained earnings are affected. So it's the statement of retained earnings. Maybe cash flow statement is not affected, but you're talking about 3 of the 4 statements are going to be affected. So it's a rather big deal. We see this. This is not. I mean, it's not common, but it does happen, and companies can restate things all the time. And I know taxes is really my area, much more than financial accounting. And as an investor, I know that I kept getting K-1s from a particular partnership I was in that just kept restating to the point where I really needed to file my tax returns, and really couldn't until I was sure that they were done restating things and going back in history and sort of making things right. So it does happen. It's not good. Nobody likes it, but it does happen. So errors happen. So what are we talking about? We're talking about things like maybe computational errors. The way we set it up in the first place is not right. We didn't set up the depreciation method correctly. We didn't have the estimated useful life entered correctly. Something has happened along the way. But the key thing is, which is what I underlined, was material errors. If it's not material, we'll just simply deal with it as we go on in the next accounting period. And when we talk about material errors, this is something that may be a little bit beyond what we're doing in intermediate accounting, because FASB has got some rules as to what's material and what's not material. And there's usually a percentage rule that they apply, whether it's material or not. One example I could think of, I had a client that was an accounting firm. It was a client of mine when I was a banker, and they made like $1,000 error in somewhere. They just didn't record it, and it didn't get recorded somehow. And they were very scrupulous. They said, "All right, do we need to restate statements?" And we said, "No, it's $1,000. It's not that big of a deal. Don't worry about it. Fix it as you go forward." Right? Material errors are those errors which would potentially change the perceptions of users had they known the information, if it were correct going forward. So what happens is you go back retrospectively. Now, retrospectively is different than prospectively when it comes to a change in estimate. When we said, okay, the estimated useful life of this machine is going to be 10 years, not 8 years, and we just simply recast everything in terms of that new estimated useful life, or residual, or whatever the case might be. Remember, we're talking about long-term assets here. Here, we're saying, okay, we got to go back and fix the problem. We got to clean up our mess, in other words. And so we're going to go back and we're going to correct them. And oftentimes we're going to do what's called prior period adjustment, which is when retained earnings needs correction. Remember what retained earnings is. It's simply the accumulation of earnings over time that go into the capital balance. It's a credit balance account, right? That goes to the capital balance of the firm itself. And so we're going to make an adjustment, either up or down, whatever the error is, right? But we're going to make an adjustment. It's called prior period adjustment. Companies don't like to do this. The financial community doesn't like it. And I can tell you, as a former banker, when companies did this, we often thought, do they know what they're doing? And I worked for a public company for the first 15 years of my career, and we were very scrupulous about not restating things, getting things right, because we wanted the broader community that we were raising capital from to know that we sort of knew what we were doing. But in any case, if it has to happen, and it maybe does have to happen, a note to the financial statements is necessary. And we talked a bit about this earlier on in the term, and I sort of showed some examples of public companies and their notes to statements. So in this case, here's the example. We have, okay, so, oops, here we are. The controller of the Hathaway Company, by the way, the controller is usually the chief accounting officer, discovered an error in recording $300,000 in legal fees to successfully defend a patent infringement suit in 2019. Now, by the way, I like this example a lot because this is one that is really one that's subject to error, particularly when we're not really understanding what the cost should be. Should it be capitalized or should it be expensed? This is not a small problem at all, right? Where some costs are capitalized, they should have been recorded as a patent expense, added to the patent cost itself as an asset, not as an expense on the income statement. So in this case, they expensed it. So the incorrect way was they created a debit expense and a cash, for all the legal fees. These are cumulative balances, where it should have been simply in addition to patent. The cash disbursement was the same. There's no difference in the cash amount. We know we're expending $300,000 in cash. But the question is, how should we have done it in the first place? And so this was done in 2021. And we're going to go back to prior years. We got to go back to 2019 and 2020 and say, okay, it should have been expensed over a 5-year period, right? 60,000 times 5 is the 300,000, right? And so we should expense patent. So this is an income statement item and a credit to the asset. An intangible, right? Remember, we're talking about long-term assets. So the intangible is credited, debit, credit, 2019, 2020. And that sort of brings us up to where we would be currently, right? That's an adjusting entry. Now, these dollar figures may not be all that large and whatnot, but what if they are big? And if they are big, it gets a bigger issue. So, and again, it has to do with materiality. And one of the things that I think we need to talk more about, I think, in intermediate accounting, is this idea of some of the principles that flow out of our conceptual framework. And one of those is the idea of materiality. If it's not a big deal, then it doesn't necessarily need to be reported. And I don't mean that to suggest that we're sweeping things under the rug and whatnot. It's just that we're sort of prioritizing those things which are important. Sometimes there are errors that are so small that they're just ridiculously small and nobody's ever going to miss it, and it's not a big deal. But when the errors are large, then it really does become a big issue. And again, FASB has laid out some rules, and if anybody wants some more guidance on this, it's something that we talk more about in some of the more advanced accounting courses, where FASB's sort of tolerance levels are as to some of these errors. Okay, and so the adjustment here is 180. It's the 60, 60, 60, and then retained earnings is credited for 180. And why are we crediting it? Because we're expensing things that we should not have expensed. So these are assets, and the patent is an asset itself. So, and whether or not you agree with the idea of treating a patent as an asset and crediting it retained earnings, which boosts shareholders' equity, is really up to your personal opinion. But this is the way the GAAP standards really are set off here. Okay. All right, and so here's a quick quiz question. In 2022, the control of the Depot Company discovered the 2021 depreciation expense was understated by 100,000. Okay, I like this question a lot because this is not something that's that unusual at all. It's a good question. So we understated it for whatever reason. I don't know who the heck knows, right? And we're saying it's a material amount, right? So we're saying $100,000 is a material. And again, I know that sometimes to non-accountants, the item materiality seems like it's something that is subject to the whims of the individual accountants and the accounting staff reporting it. Not so much. I mean, I think $100,000, is probably material. Maybe to Microsoft, it's not material, okay? Or to Amazon, it's not material. To I don't know what depot company is. But we're given in this case it's material. So $100,000, assuming the income tax rate of 40%, the prior period adjustment should be what? Okay, a couple things going on here. First of all, we have an understatement of depreciation expense. So what does that mean here? It means that we've made a mistake on depreciation, which then translates to a mistake on net income. So what the heck do we do here? Well, take a look at this. And I know that this is probably a little bit beyond what we are covering here. And I know that personally, I think that we ought to incorporate tax more into intermediate accounting, but we only have so much time, so many hours in the day. But let's talk about what this adjustment looks like, okay? So in this case, the correct answer is going to be $60,000 debit, not $100,000, because why? I've underlined here, we're saying it's a material amount. 2021 net income was overstated by $100,000, but the tax effect was 100,000 times the reciprocal of the tax, or the complement of the tax rate. So, and this is something that if you have not taken a finance course before, and for those of you who are going to study for the CPA exam, you will probably come across this. If the tax rate is 40%, which is high now because it's 21% for C corps, but it'll be 1 minus 0.21. But let's just go with what the numbers here are. Then you multiply this factor times that, and you times 100,000, you get 60,000. So and think about why we're doing this. We've already paid tax on that. If we've understated one thing, then we've overstated another thing. And what I'm talking about here is if we have dealt with one, so depreciation expense was understated, which means that the tax net income was overstated. And so a consequent adjustment of retained earnings, which is a net of tax issue, is required, and it's a debit entry. Okay, it's a debit entry. And income tax on the 100,000 was already levied in the prior period. Now, this ignores the fact that a company might just simply refile and do an amended tax return. And again, I really don't want to get too tall in the weeds of tax filing, but this would be the financial statement adjustment here, right? We've understated depreciation, so it means we've overstated net income, which means we paid too much tax, right? And so we're gonna reflect that for that particular accounting period, right? And all we're doing is simply making that adjustment. It's what we call a prior period adjustment. All we're doing is simply changing and making this adjustment. If it's a small amount, it's no big deal. Nobody really cares, and most people understand. And in fact, it may even be looked upon as a positive in the sense that the accounting staff is on their toes and they're looking at things. If it's a big, if we're talking about 8, 9 zeros, well, that's a different story. Who could miss that? So it's a different deal altogether. But this is an example of an adjustments made because of some error that was made for whatever reason. We don't know why the error was made. It doesn't really matter. All we know is we need to sort of fix the problem as it comes along. Okay. All right. So we got about 35 minutes. Let's talk about impairments. All right. This is a big issue. Impairments are important because it comes up again and again and again with long-term assets. Remember, one of the things about this, and I don't mean to be cute here, but when we talk about long-term assets, we are talking about the fact that they are long-term in nature, and things can happen in the long term that don't happen in the short term. This is why the long term is considered to be a more risky environment, more risky business environment than the short term, because things can happen. In other words, things, and we're talking about the like typical accounts. We're talking about bad things that can happen, right? And we're talking about things that can impair the value of a long-term asset, or a group of assets, or a factory, or subsidiary, or an entire division, whatever the case might be. All these are subject to what we call the impairment rules, which we're going to talk about. And by the way, they differ from the international. The GAAP rules differ from the international rules in some important ways. And again, as I've said numerous times before, one of the big issues that separate the GAAP standards and the international standards are asset valuation. I think it's far and away, in my experience, the biggest issue that separates them. But we have to know them. And so you're thinking, okay, I have no plans to work in, I don't know, Mexico or Argentina or France or Italy. Well, maybe that's true, but maybe what if a client that you work for or a company you work for has international operations, which is, by the way, more likely than not in this world of globalized business. You're going to be subject, if you want to work in the accounting profession, you're going to be subject to the international rules. And so, and again, as I've said before, we're not trying to bring out all the rules. I mean, we're not even bringing all the FASB rules, much less all the GAAP rules, much less the international rules. But it's important to know there are differences. And in this area, there are some pretty stark differences, particularly given the fact, and I bring this up only because of the fact that some of these valuation changes are material. And materiality is this issue where a user would want to know that there are these differences going on. So we talk about impairment, we're talking about a long-term change in value based upon certain events that are happening, most of which I think probably, or maybe, well, many or maybe most are due to external factors, but it doesn't really make any difference. You can't call your mom and say, hey, there's a problem. The problem is that something is outside and you got to deal with it, right? And you got to recognize an impairment. Going into it, we're simply saying that from a good faith estimate, we're saying this is what the value of this asset should be, and we're going to put it on the books this dollar value. And we have no reason to believe, we, the company in this case, have no reason to believe that there's going to be some sort of change that's going on. However, situations can arise. And your text has got a pretty good description of this. I really like this part of the text. I forget the page number, but where things can happen. A fire or something is written off as a loss. Or it has to do with the fact that whatever you're making is just not selling with the customer itself. And to the extent that we can isolate the value of particular assets involved with a revenue stream that is associated with that asset, the better off it allows us to do an actual impairment. It becomes a little trickier, and your text gets into this where you've got multiple assets sort of grouped together, and you've got machines that are producing 4 or 5 different products. It does become tricky in that regard. But welcome to the world of accounting, where we have groups of things, and it makes it difficult. But here we're going to sort of talk about cases in which I think it's a little bit more recognizable. So we talk about impairment, what's going on. So what do we do with an impairment of an asset? We say we're going to write the value of that asset down. Once we know that it's happened, and the FASB has said that once the management recognizes there's an impairment, they should write it down. It doesn't have to be at the end of an accounting period. It's not an adjusting entry necessarily. When we think about adjusting entries, we think of as we approach a quarterly or an annual reporting period. This is whenever we recognize there's something that's really gone wrong with what's happening. A lot of times, and frankly, this is just part of the risk of doing business in the world, is it's outside influences or factors that we have no control over. And it happens all the time where companies can't control the cost of resources. So as a result, their costs are upward, or the price of their output is not achievable because of competition with it. This is just the jungleistic nature of what's going on. So in this example, we got Murphy Oil in 2016 reported impairment charges of $95 million. Charges reflect the decline in asset values associated with lower oil and gas prices. These are output prices. This has got nothing to do with the assets themselves being impaired, damaged, burned up, whatever. It could include that. I'm not saying impairment does not include that. I mean, sometimes it is a damage to the asset itself, but a lot of times it's external factors. It's not always. I mean, sometimes you get a case in which, like my family owns farmland, and we lost an acre to flooding. It was a creek changing course, and so we claimed an impairment. There's nothing we could do about it. It was just an impairment, right? It was not an operational failure. It was not an asset decline. It was just simply external factors. But sometimes, and this is often the case where it's external factors that are going on, lower oil and gas prices. So we're going to write that down in the period in which we recognize it happens. And we're going to get to the methods that we get there. And I really particularly want to highlight the differences between international and US GAAP standards. And so what we're going to do is we're going to talk about what the future cash flows are, which is sort of a test for impairment that we're going to get to. And if it occurred, it's difficult to measure what the amount of the write-down is. And this is something that I think is really, really important to know. And it's not as unusual as what it might seem. it might seem like impairments are like one-off things, like an asteroid landing on Espanola. Well, that's probably pretty unusual. It's less unusual than that. It's probably a little bit more common where something has materially happened where the asset that is associated with cash flows arising from that utilization of the asset are impaired. And we'll talk about what the tests are for that particular means of getting the right end. So we're talking about assets that we held use. Different guidelines apply to those with finite lives and infinite lives, indefinite lives. We're going to talk about this. The indefinite life issue really relates more to intangibles. We're going to get to that in a second here and talk about that. Remember, indefinite useful lives, goodwill looms large here because we don't amortize goodwill. Okay, it's an intangible. Up to this point, the last few minutes I've been talking about tangible assets like equipment and factories and whatnot. But there is an impairment possibility with all these other intangible assets as well. And so we'll talk about some of the issues that are going on here. Remember, goodwill is not amortized. It's simply an accounting treatment that treats the price of the fair value acquisition price of assets against the book value of those assets. And it's a way that the companies can justify that and capitalize it as an asset. So, all right. So according to GAAP, assets are grouped at the lowest level of which identifiable cash flows are largely independent of the cash flows of other assets. What the heck does that mean? Okay, this is a rule that says, okay, sometimes it's really hard to know, do we record impairment because of one particular asset or the assets that may group to which it applies, whether it's all computers or all machines or all conveyor belts or whatever, or trucks or whatever. And so we want to try to bring this down to the lowest level possible. Easier said than done, easier said than done. I know this is one of the toughest issues here, but we're going to test for impairment only if events or changes in circumstances indicate the book value of the asset may not be recoverable. Okay, this is a big one here because this contrasts in a pretty large way with the international standards. When we talk about under GAAP standards, which is mostly US standards, we're talking about only if events or changes in circumstances indicate the book value or asset group, again, all computers or all whatever, may not be recoverable. And we'll get to the test in a second. We'll get to that. But this is different than the international standards, in which the international standards require that firms test every year for this issue. So we're a little bit more lenient here. And I think we come back to this idea once again that the international standards are a little stricter on the accounting conduct, the requirements of accounting firms with their clients in terms of these tests, and so it's a little stricter. And in some ways, I do not disagree with them. I think there's a lot to be admired in the international standards, even though I teach GAAP accounting. So, but nonetheless, we teach it because why? Because a number of you may be involved with international standards at some point, because bigger companies oftentimes do business overseas, and we're only it's a very easy, between breakfast and lunch drive to another country here, right? Which has international standards that differ, right? So, all right. So, what are some of the events that may change the circumstance? Again, it could be the market price of the good has gone down, and that's something that is uncontrollable, probably for the most part. How the asset's being used or its physical condition, and sometimes the physical condition is such that, and it could be damaged, it could be weather beaten, it could be there was excessive amount of optimism early on about what this asset could do. So as a result, that could be an issue. It could be a change in legal factors. That's a very common one where whatever we're producing, maybe it's outlawed. Maybe we can't sell this particular good for whatever reason. So it's going to really limit the cash flow that's going to result from that particular asset, right? Or group of assets or a plant itself, right? Whatever it is we're producing. So legal factors are a big one. And it's not just the case in the US, it could be overseas where the company doesn't want us to produce whatever it is, whatever the case may be. Sometimes countries will have protectionist legislation that really discriminates, frankly, against foreign producers. And so as a result, that's a material change in the facts, and it may affect the cash flows arising. And we're going to get to this whole idea of cash flow in a second. Now, accumulation costs significantly higher. Okay, it means it costs more to maintain. We're going to be really talking, when we talk about cash flows, we're going to get to it in a second. We're really talking about net cash flows, in minus out, that sort of thing. And so or current period loss combined with history of loss and things are getting better, that sort of thing, or the asset will be disposed of prior to the estimated useful life because we no longer need it. And one thing that comes to mind is the idea of very cutting edge equipment. Remember, we're talking about PP&E here. We're not really into intangibles just yet. Property, plant, and equipment. We've got really cutting edge equipment, and it's going to rapidly lose value because of the fact there's going to be new competition in the market. It's going to improve on that particular good. And this particular asset, yeah, we paid a lot of money for it, but it's no longer as good. So it's an impaired asset. We got to write it down, right? Simply because of the fact that the world is changing quickly, particularly with technology and high-tech goods, whether it's, internet, software, biotech comes to mind here as being these areas where things are changing rapidly. And as a result, the assets that are involved in the production of those may not be quite as valuable as what they ought to be before. So, all right, so let's talk about the steps here. And this is the gap standards for how we do this, the process. And so, first of all, we're going to do what's called a recoverability test. Now, by the way, this is not something that's routinely done. It's done when there's a suspicion on the part of management that the assets in question are potentially not being reflected there. They're at a book value, right? And we're going to fall below book value. Now, we're not putting things on the books we're not stepping them up for fair value, but we are going to mark them down if there's an impairment, right? And that's, again, one of the big differences between GAAP and IFRS. And so there are two steps involved. So step one is what we call a recoverability test. This is not the same step at all with regard to the international standards. The recoverability test says, okay, the impairment has occurred when the undiscounted, I underline undiscounted, sum of estimated future cash flows is less than the asset's book value. So all we're simply saying is if we think this asset's going to last 10 years, what is the cash flow, the net cash flow, in minus out, that we can expect to get over that 10-year period? If it's less than the book value, we have an impairment. But we don't simply take the difference between the two to do that. Instead, we have to measure it. So the impairment goes, all right, so if step one has said this asset has failed the test, right, where the cash flows do not exceed the book value, then we have an impairment. But the question is, what amount do we record? This is where step two comes into play. So we record impairment loss for the amount by which the fair value, not the undiscounted cash flows, fair value is less than its book value. Now, I cannot think of a circumstance, and I've seen this numerous times before, I can't think of a circumstance where if the cash flows do not exceed the book value, that somehow the fair value is going to be somehow greater than the book value. And I just can't see how. I suppose theoretically it can happen, but for the most part, fair value is going to be less than book value, and that difference then is what's going to happen. Okay, if there's no impairment at all, then there's no loss recorded in the GAAP standards. But if there's an impairment, which is basically this undiscounted cash flow, and what do I mean by undiscounted? Meaning that we're not using some interest rate factor, some present value factor in discounting those cash flows, because we know that a dollar in hand next year is going to be worth more than a dollar in hand 10 years from now or whatever, right? So we have to discount those using the appropriate discount rate, which is interest rate, right? Going back to present value tables, right? So if we know that's the case, then we have an impairment, but the recording impairment is simply the difference between fair value and book value, and we record a loss. And it's a one-time loss, right? That's recorded. I mean, well, I say one time. I guess it theoretically could happen again and again, but we're recording that as a decrease in the value of the asset. So if instead we write down the value of that asset, so the fair value is the amount at which the asset can be bought or sold in a current transaction between willing parties. Okay, this is the area where for those of you who may take advanced accounting courses, we get a lot more into this. It becomes difficult as to what fair value is, particularly for very unique assets where there's really no market, and there's certainly no quoted market price. And the highest standard of proof as to fair value is in quoted market price. We could say this particular asset would be sold today at as is at a arm's length transaction of X dollars, right? But what if there's no market because it's a very, very thin market and there's not enough data out there, so you don't really know, right? So there's not a determinable, you have to estimate it. Well, how do you estimate it? Well, it's difficult, and you can do the best you can. And this is sort of level 2 here. But if you can't do that, we've got to go to level 3, which is the fair value, is the estimated present value that is discounted as to future cash flows. And this is asset specific. We're not really talking about the market itself because we don't know what the market is. This is a very unique piece of equipment. So we're saying, okay, we expect the fair value to be the estimated value of future cash flows. And all that is, by the way, because I know a lot of people here took Business 1180, this is not present value of an annuity, because the present value of an annuity table would use a fixed amount every year, which is what an annuity really is, right? We're simply saying, okay, the cash flows may differ year upon year upon year. We're going to take every year, discount it back 1 year, year 1, year 2, 3, 4, discount it back, and presumably at the same discount rate. And the discount rate is simply an interest rate that reflects the cost of capital of the business. There are a lot of different numbers that can be used. The point that we want to make is the idea, though, that it's really the last step. It's the only thing left for the accounting staff to do in order to determine what the fair value ought to be, because we're trying to get the difference between fair value and book value in order to record the impairment loss. So in the absence of a quoted market price, we don't really know what to do, right? Okay, so when we talk about undiscounted cash flows, this area is really used to sort of differentiate undiscounted from discounted. So there are two different things going on here. Okay, and I want to make sure everyone is familiar with what's happening. When we're talking about the determination of an impairment loss, step 1, we're using undiscounted cash flows. Okay, so in other words, we're saying $1 million a year from now, $1 million 2 years from now, 3 years from now. We're not discounting the out years for the time value of money. We're simply taking the undiscounted amount. Whether you like that or not, is subject to your own opinion, because the international standards don't really like that very much. But it's the way that we would do that. When we talk about that's step 1. That's to determine whether an impairment loss has occurred. The determination of the loss is when it's applicable. This is my language. It's when the discounted cash flows, which do use an interest rate, where we're simply saying N and R across the table, and the R is some interest rate, is being used. And so that's a different story. That's step 2, not step 1. Okay. And in any case, whenever an impairment is done, a disclosure note is necessary to report to users what's going on, what are the facts, what's happening, whether it's one asset or a group of assets, an entire factory, an entire location, entire enterprise, whatever the case might be, and what's going on. And the term facts and circumstances, which is sort of a legal term that we are sort of applying here, will apply what's going on, because every situation is different, so we have to report why this is going on. And the amount of the lawsuit is not separately disclosed, and the method used to determine fair value. And so companies will be very specific as to what is being done in order to get to fair value. And impairment losses don't happen every year, but sometimes they do. And bigger companies and large multinational companies are often going to have impairments because things go wrong. And we're talking about companies that do business in 120 countries around the world. Something's probably going to go wrong somewhere, and some asset's going to be impaired, and somebody's going to have to report that. And if it's in the U.S., the asset itself, in other words, we're going to report it under the GAAP standards. If it's elsewhere, it's Germany or Russia, or well, maybe not Russia, but Germany or Italy or whatever. We're going to report it differently. So here's an example. The Dakota Corp operates several factories that make medical equipment. Near the end of the company's 2021 fiscal year, a change in business climate related to a competitor's innovative products indicated to management that the $170 million book value, which arises from what? The original cost of $300 million minus accumulated depreciation of $130. 300 minus 130 is 170. That's the book value. In other words, the net book value, net of depreciation, accumulated depreciation. And so, and we're saying that the recovery may not be there over time. In other words, we use assets to do what? To generate income. If we're not generating income, what the heck are we doing, right? So again, we're making the assumption these are profit-making entities, for-profit entities. And so management is able to identify cash flows and estimates future cash flows from the main use of the factory, which is undiscounted, right? $150 million. But the fair value of the creditor's assets is not really available, but it's estimated to be $135 million. We don't know where this estimate came from, but again, we're assuming that there's a good faith estimate. So 170 and 135 are different, right? So there's an impairment, right? So first of all, we knew there was an impairment because the cash flow is not there to support the book value. But in other words, the cash flow was 150 million. These are undiscounted cash flows. There's no, all we're simply saying is we're adding them up over time. Okay. We're not discounting them 1 year, year one, year two, whatever. And so we know we have an impairment. 150 is less than 170. But in order to record it, we have to take the difference between the book value and the fair value, which is estimated. So 170 million is greater than 150, which we just talked about. How do we record the impairment loss? It's not the cash flow, it's the fair value. And so in this case, the fair value is 135, book value is 170. And so as a result, we have an impairment loss of 35 million. So what do we do in this case? This is important to know because we have to mark down the value of those long-term assets. Remember, this is property, plant, and equipment. So what are we going to do? Well, the impairment loss is 35 million, which is a debit balance. Losses or debits, gains or credits. Accumulated depreciation, we're going to sort of write down here to 130 million. And we're going to write down the value of the factory assets to 165 million. So we're going to take 300 million, which is the original acquisition cost. We're going to put a credit balance of 165 in order to bring that asset down to 135, right? And that's the way we're going to, so that's going to be the new carrying value. And carrying value is that asset value that goes on and on and on. And we'll go from there, right? And maybe there are subsequent impairments going on. Unfortunately, that could happen. But in this case, we have marked down the value of that asset, given the fact that we do not expect, I say we as we're in management, it is not expected that there will be a recovery of cash flows resulting from that. Okay. All right. So the questions about how we record the impairment loss. Remember, we got to do through step one first, and go to step two, and then we kind of deal from there. So remember, the credit to factory assets here is a reduction in the value. Remember, it's a write down of those assets, and that's really what it is. We debit impairment loss, and we credit the asset itself. And it's a one-time event, and hopefully it doesn't happen again, but I suppose it could. And but that's how we treat it, based upon all the factors we talked about earlier that may be an influence. Okay. All right, so a quick quiz here. Hallberg Incorporated owns a factory of which paid 270 million. At the end of 2021, the book value is 189 million. Okay, not good. Due to adverse economic conditions, Hallberg's management determined that it should assess whether impairment loss should be recognized for the factory. The estimated undiscounted future cash flows is 180 million, and the factory's fair value at that point is 120. Under these circumstances, what should the company report? Well, we know for the first test has been failed. That is, the cash flows are not going to be sufficient to cover the book value of 189, right? So it's 180 million. It's a huge difference. $9 million. I mean, I guess it's big enough, but the fair value is much less. And so as a result, what are we going to do? Well, it's going to be 120 away from 189, which is going to be 69 million, and that's going to be now the impairment loss. We're going to debit impairment loss for 89 million, and we're going to write down the value of the assets of 89 million. Debit and credit both equal, and we're going to bring down the book value of those assets or a group of assets, whatever the case might be. So the same sort of logic applies in this case. And again, I don't want to read all this here, but I did underline some things. This is an example of what an impairment loss might look like, as documented in the notes to statements. And so Macy's, I don't know what year this is, but the carrying values are periodically reviewed. Now, this is interesting because there's no requirement that FASB has that says we have to look at every single long-term asset every year and determine whether it's been impaired or not. It's more a judgment on the part of management. Whether that's a strength or weakness is up to you, I suppose, but periodically reviewed. They're not like reviewed on a predetermined schedule. But the estimated cash flows includes management's assumption of cash inflows and outflows. This is what I want to talk about. We're talking about net cash flows in and out. What the difference is. Presumably, the inflows are going to exceed outflows. Otherwise, you've got a bigger problem than what we thought before. And directly resulting from the use of those assets and operations. And they're going to be tied to that. Remember, this is one of the things that FASB requires, is the idea that we really drill down to isolate those assets that are involved in creating the value in the first place. And so can we separate? Are these assets separable? And so that's essentially what's going on, right? So and I want to kind of go forward here because I did some underlying because I think it's really important. The fair values of these assets were calculated based on the projected cash flows and an estimated rate of return, and it's a risk-adjusted rate of return. Now, risk-adjusted rate of return implies there's a rate of interest, okay? Based upon the riskiness of cash flows, and some of this leads us into finance and whatnot. And right now, all I'm simply saying is there's an interest rate involved, and that's how we're going to value these assets. In other words, what are we saying? There's no quoted market price available. We don't know how much these assets are worth in the market. There's just no way to know. And this is not uncommon. How the heck do you know what something is worth? A bunch of light fixtures or mannequins. I mean, who knows what these things are worth? And so we're going to go all the way down to the number 3 here and say it's going to be based on projected cash flows. Here we will use a rate of return based upon the rate of interest, and really the interest is going to be used in the marketplace itself based upon that. So, and again, this kind of gets us into finance a little bit, so I don't want to get too deeply into the woods here. But other than to say that there is interest rate involved, so we are talking about discounted cash flow. That's step 2, not step 1. This is how we determine, or in this case, Macy's determined as the amount of impairment loss. And if there were a readily quotable market, we could use that, or if we could estimate it. But sometimes companies can't estimate it. It is sometimes really, really hard to know what an asset is worth. This is why the historical cost principle is sort of lives on in GAAP accounting, because we know that somebody's willing to pay X dollars and somebody's willing to receive X dollars. And so at least at some point back in the historical acquisition date, somebody's willing to part with this amount of money and somebody's willing to say that was a fair deal, okay? So we got to kind of understand those are the challenges that are going on. And so this is kind of the last thing I want to talk about, which I think is sort of the main event here when it comes to impairments. We've covered a lot of ground here. I know this is a dense chapter. I know it. But I want to talk about this idea of the differences between these, because I know that when we talk about international standards, it really sort of gets to the idea of maybe future accounting courses. For those of you who want to maybe do an MBA or an accounting or whatever, maybe you'll come across these more. But these are some rather important differences. And again, under GAAP standards, there's no real requirement about when you have to assess these long-term assets. Under IFRS standards, all these long-term assets have to be looked at every year. And the indicators are similar to GAAP, but the analysis is required more frequently and on a regularly scheduled basis. And that's simply the way the IASB has come up with that. The impairment losses required with the undiscounted sum of estimated cash flows is less than book value. We talked about that. Here, there's no similar test, but it's what we call the recoverable amount is the value in use, which is the present value of estimated future cash flows, which is what? It's a discounted rate of return of these cash flows. Year 1 at 5%, year 2 at 5%, year 3, and different dollar amounts, right? Presumably, but the same sort of discount rates being used, presumably. And so one is undiscounted. This is the test, the step 1 test. The step 1 test here is a little bit different. And we measure it, but where fair value is less than book value, the difference is recorded. Here's the amount by which the recoverable amount is less than the book value, which again, a recoverable amount is this idea of the higher the value, which is the discounted or the fair value less any cost to sell, right? And you can look at this for yourself, but that's how the impairment loss differs substantially. And in GAAP, we cannot, reverse the loss, but we might under international standards if the facts have changed. And we're saying, okay, well, maybe we're in a recession and we're making peanut butter with this factory, and maybe nobody wants peanut butter or whatever. I'm just kind of shooting from the hip here. But the economy's changed. Now people want this. And so we can reverse that. We can't do it in GAAP standards. It does not allow us to do that whatsoever. So we've marked the asset down. We got to kind of live with it and go on from there. And again, fair value is a concept that the international standards is much more open to than what we call fair value accounting, than what we are in the GAAP standards, which are more historical cost based. So the test for impairment annually, more frequently, if events change in circumstances, and we're talking about intangibles here. So I'm almost out of time, but I want to talk a bit about intangibles. Here, you do, under the GAAP standards, want to test annually, but it's not some super difficult thing. It's maybe more frequently events are changed or events have happened where it's going to affect the life of the value of the intangible. Remember, intangible assets are really assets are valued as such because they have legal rights that are bestowed upon the owner, and they can use a trademark, copyright, they have a patent process, whatever, but they have value. And so as a result, we need to determine whether that value is being impaired. And we can test it annually, we should, right? But it's not, a really difficult process because I don't think at least, but as to what's going on. So the company has the option of taking qualitative assessment first. Remember, there's a lot more flexibility in GAAP standards. A lot of companies are allowed a lot more leeway than they are in the international standards. A qualitative assessment is, are we actually losing the value that is attached to this particular asset? And without numbers, we're just simply saying, is there a qualitative test? Do we think that this asset has lost value for whatever the case might be? And then the measurement is a one-step process. If fair value is less than book value, the impairment loss is recognized. If we know what the fair value is. But there's no recoverability test. There's no step one. It's just one step. I mean, I guess there is a step one. It's not the same step one. There's no step two, in other words. And so all there is a recoverability. There's no recoverability test. It's simply saying if book value is greater than fair value, then we have an impairment loss. And when it happens, we simply mark that asset down. But if it's and when we say it's available for future cost allocation, if it's indefinite, like goodwill, that's goodwill sort of comes to mind. It would not include amortization because the asset has an indefinite life. Remember, with indefinite life assets, intangibles that is, there is no amortization because first of all, we don't know what term to amortize those over. And so we're not going to be able to amortize those. And then a couple things here before we leave, we've got about a minute left. We have US GAAP, impairment of value. A company can choose first to provide only qualitative assessment. These are indefinite life intangibles, okay? And they can do a qualitative test first, which is a little bit squishier, I think, than a quantitative, to be honest with you. Under the IFRS, it requires indefinite life assets to be tested for impairment at least annually. If you have not already caught on this is a theme in the international standards, test these longer-term assets annually to make sure that they are not subject to impairment. If they are, then we need to make a change. We need to mark those assets down. Not quite as stringent a requirement under the GAAP standards. Under GAAP, also, the impairment loss is measured as the difference between book and fair value. Here, it's the book value recoverable amount, which does take into account cash flows, so it's a little bit different. We prohibit reversals, but at IFRS, we can reverse an impairment loss if those circumstances are gone. Again, where maybe the goods weren't selling because whatever was being made, but now, hey, people are back into it, and so now we're going to sell these goods, so therefore we can reverse that impairment loss. These are not permanent events associated with that particular asset. Okay, these are things that can be reversed over time if the facts and circumstances change to make that happen. Under GAAP standards, if certain criteria is met, we can combine assets, but under IFRS, we're not really looking to combine them. We're trying to pull these assets apart. We've seen this before, particularly when it came to depreciation, where we would like to treat as many fixed asset components as possible individually rather than as a group. And I think there's a lot to be said for that. But that is the way the IFRS standards are with regard to things right now. Okay. All right. So we're out of time. So this is a good place to stop. And we're going to talk about goodwill and what goodwill is. It's an indefinite life intangible asset. And we'll talk about that in my supplementary video, which I'll probably get to on Wednesday, I think. Thursday, probably the latest, I hope. And we've got a little bit yet to cover here. But when we come back on Thursday, I do want to sort of jump into Chapter 13 and start talking about that. So in order to talk about current liabilities and all that. But I will cover the rest of this because this is interesting and there's a lot to do. There's not a lot to do, but there's one more video I can do sometime this week, hopefully before you start to work on the homework for this week. So I'll start Chapter 13 on Thursday. So if you have any questions, feel free to reach out to me. I'm here all week, and I'm more than glad to help you. And have a great rest of your day.